In this video, I want to talk a little bit about the equity measuring investors' total return in a case when you are a leveraged position. So first, I want to give you a bit of theory. In particular, I want to talk about margin, leverage ratio, the relationship between them. Then I want to talk about margin maintenance required and the margin call. So I want to bring all of this together. So usually, if you're not having an intermediary and you have a pot of your own money, own fund, you are not leveraged. But if you want to get your own money and other people's money, then you are leveraged. Okay. These are your total assets, total funds, but you are investing this, and this other people's money, they won't give you the money for free. They want some return on their capital. And if you think about your own fund as a percentage of the total fund, this is called the margin. So your margin could be, for example, 50%. Okay, that would be your total equity, right? Your own fund or your equity could be 50%. So half of them of the total funds is coming from you, and the other half, the other 50%, is other people's money. Okay. So what is the process? You use this total funds to buy shares, and then after you liquidate, you buy shares, and then you sell shares, and then you have to pay back the capital to the people that gave you money. You have to pay back commissions. You have to perhaps receive some dividends, right? So you sell the shares, and in these selling shares, you're going to return capital to others, right? And then whatever is left over for you is going to be either a profit or loss. Okay. Now, this margin of 50% could equivalently be thought of as a leverage ratio of which is the total assets or total funds, let's call it funds divided by your equity. Okay, which if you think about it, the inverse of this, so it's 1 over the margin. So there's a one-to-one relationship between margin, which is the percentage of funds that you have you have put from your own money, and leverage ratio, which is the fraction or how many how many times you have leveraged or expanded your equity. So in this case, it would be two, because if I take one and I cut it in half, I get two pieces. Okay, so the leverage ratio here it is two. So for every 1 unit of your own money, you are able to invest two units of money. Okay, that's the idea of the leverage ratio. Now, if you ignore for a second the return on the capital of this individuals here, right? The leverage ratio amplifies your earning or your losses. So say, for example, we ignore return on their capital, maybe because it's small. Let's say, for example, you borrow for just 1 day. Okay. Let's ignore commissions because generally they're a small percentage. So let's say, for example, the stock that you borrow today goes up 20%. Well, if your leverage ratio is 2, your earning on your invested capital would be 40%. Okay. But if that same stock goes down 20%, then you'd have lost 40% of your capital. That's a big picture thinking about how you want to think about what happens when you have leverage. And to get into more details, when you look from the perspective of these other people want to be guaranteed that they're going to get their money back. And because they're guaranteed, if these shares go down in price, so shares go down in price, then the margin, right, the percentage that it's your own money also goes down, right? Because you have to still return other people's money. So your equity acts as cushion to those losses. And therefore you have to return that money to those people. And these people, or these other people's money, might introduce a margin maintenance requirements. So they might say something like, okay, your initial margin was 50%. I will allow you for your margin to drop to maybe 30%. But if it drops to 30%, I might call you, I might give you a margin call and say, hey, if you want to keep this position, because I could liquidate it and get my money back, right? At any time, I am the broker in there. If you don't put more money so that you increase your margin, maybe to the initial margin of 50%, then I'll close your position. Effectively, this margin requirement, let's say of 30%, is effectively guaranteeing that those other people's money, that even if your shares drop by 30%, they'll still be able to get their money back. Okay. But they're feeling a bit uncomfortable or uneasy with that. So, in short, we've kind of covered a little bit of theory. A margin, or is expressed as a percentage, is the percentage of equity that you have in a leveraged investment. Leverage ratio is another way of looking at your amount of loans that you have, which is the inverse of the margin, right? So if you have 20% margin, only 1/5, which is equivalent to 1/5, then your leverage ratio would be the reverse of this, the inverse of this, which would be 5, right? So every $5 of fund, you only have uh, you have $5 of fund for every $1 of equity. Okay. Then there's margin maintenance requirement, which is there to protect your lenders. Okay. They are there to say, I want to make sure that you have enough of your equity. So if the asset that you bought goes down in value, I have some assurances that I will get my money back. And whenever your account goes below your margin maintenance requirements, and of course that happens when your position deteriorates, so you bought your stock, for example, but that stock goes down in value, you might get a margin call. And that's sort of the first video. In the next video, I want to show you an example and give you a ballpark idea of how you go about questions like this.